another video, and in this video we are going to learn about balance sheet. So what exactly is a balance sheet? A balance sheet tells you about the company's assets, the company's liabilities, and the shareholders' equity. Basically what a company owns and what a company owes. In case you don't know what assets and liabilities are, in the words of Robert Kiyosaki, the famous author of the book Rich Dad Poor Dad, he says assets are something that brings money into your pocket, while liabilities are something that takes money away from your pocket. Now let's see how a balance sheet works. We will see a balance sheet of a company and figure out what a good balance sheet looks like. You need to notice 2 or 3 good things in a balance sheet. And like income statement, balance sheet is made only on one day, right? They choose one day, that's probably somewhere in the March when the financial year ends, and they make a balance sheet on that day, what all the company owns and what all the company owes. So on that particular day, they take out the list of assets they have and they take out the list of liabilities they have. They jot it down on a paper, and that paper is called the balance sheet. Now let's look into an example of a balance sheet and how a good balance sheet should look like. Let's go to tickertape.in and let's search for a company. Let's take an example of Amara Raja Batteries. Financials. You go to financials and you go to balance sheet, and this is how a balance sheet looks like. As I said, the balance sheet consists of the assets and the liabilities. Assets are comprised of current assets and non-current assets. Liabilities also consists current liabilities and non-current liabilities. So current asset would consist of cash and short-term investments, as in the amount of cash that you have right now, and short-term investments which you are planning to redeem soon, right? The receivables, as in, for example, if you have, given something to someone and you're expecting money back from them, you can consider that as total receivables. Total inventory, whatever the company has been producing and which is about to be sold. So those things are considered assets because they will sell those things and then they'll get money. So the inventory is also considered as assets, and other current assets, right? So these are current assets. Non-current assets would consist of loan and advances, net property or plant or equipment, as in where the products are being produced and the machinery that is being used, that is also considered as assets, right? The intangibles and the long-term investments, as in the investments which you have given, which you probably do not want to take your money out of it, and you're expecting the money to grow significantly in the coming years. That can be considered as long-term investments. DTAs and other assets. So these are the constituents of non-current assets. All these make the total assets. And if you want to see current liabilities consists of these things: the accounts payable, the total deposits, and other current liabilities. And the non-current liabilities consists of the long-term debt the company has, the tax liabilities that the company has, and other liabilities, right? So that gives you the total liability of the company. Total assets can also be given by the formula: total assets is equal to the total liabilities plus the shareholders' equity, right? So if you can see, the total assets and total liabilities and shareholders' equity are always the same every year because it's literally the formula. So this is what a balance sheet comprises of. Now, what do you see in a good balance sheet? All right. So the first thing that you really need to see in a good balance sheet is the total assets is increasing every year. So let's just go back till 2012. If you see from 2012, the total assets of this company has been increasing, right? So this is one good thing about the company. The next thing that you need to see is the liabilities. In an ideal world, the total assets would keep on increasing and the total liabilities would keep on decreasing. But that cannot be the scenario. You need some sort of liabilities, and it is not necessary that a good balance sheet would have the liabilities decreasing all the time, but the liabilities should always be less than the assets. So if you can see here, since 2012, the liabilities has always been significantly lower than the assets. After you have analyzed the assets and the liabilities, the other thing that you need to see is a ratio called debt to equity ratio, and this is a very important concept. Debt to equity ratio is equal to total liabilities by total shareholders equity. So that would be, for example, for the year of 2020, the debt to equity ratio would be 1147.67 by 3655.31. And make sure the liabilities are very less and the equity is going higher always in a debt to equity ratio. And the other ratio that you look into is the current ratio. How do you find the current ratio? The current ratio is found by current assets the company owns divided by the current liabilities that the company owns. The debt to equity ratio should always be decreasing, all right, and total equity should always be significantly larger than the total liabilities. When you are checking the current ratio, the current assets should be significantly larger than the current liabilities, and the current ratio should always be increasing, right? That's an example of a very good company. So this was all about balance sheet and all that this video would contain. I will see you in the next video. Till then, take care. Cheers. Bye.